Most investors panic and lose everything during market crashes, while the top 1% use these moments to build generational wealth. I'll show you the top 5 crucial lessons from 100 years of market crashes that could have helped you spot winners like Meta, which did 720%, and NVDA, which did 1,300% after the 2022 market crash, while others missed out on these lifetime opportunities. In this video, we are going to see why bear markets create massive wealth opportunities. We are going to also learn about the hidden structure of bear markets that most investors miss. I don't think you want to miss this one. We're also going to learn about bear market rallies, which I think is the #1 wealth killer that very few people warn you about. And then we are also finally going to see how to position ourselves for triple-digit gains after the bear market ends. So my goal with Profit Punch is to help you make money when the markets are great, and then I also want to help you protect your money in bad markets by you staying out, or if you're very adventurous, trying to make money on the downside as well by using shorting. With half a decade of experience in the markets, I've helped Profit Punch members spot winners like Upfolio, which did 350% in 2 months, SMCI 200% in 2 months, NVDA 200% in 2 months. Our newsletter doesn't just send you alerts, we also teach you all the necessary strategies and provide complete educational resources so that you can understand exactly why these trades work. Grab our free guide called 10 chart patterns that made me money and 10 that did not, using the link in the description below. This is the exact system we use to find these massive winners before they take off. Now, the first point is that bad markets are the biggest opportunities. Whenever you see bear market, the one thing that should enter your head is I should keep watch of the strongest stocks in the stock market crash. And when the market recovers, these are the stocks that I want to buy. So during a bear market, you have one task: to stay out or to short if you want to, but the best is to stay out for most people and just look for the strongest stocks in the strongest sectors. The industries which did very well in the previous bull market run are rarely the industries that are going to do well in the next bull market run. So if coal industries did well in the last 4 years and there's a bear market, then they're not likely to be the best new leaders this new time. So you always have to keep a very vigilant eye. And these stock market crashes come once every about 5 years. And I'm about to show you why they're the biggest opportunities. Because every 5 years when we have that market crash and then the markets recover, on average, it's not every time 5 years, but on average 5 years, we have a crash and then it recovers, then I want you to be using the weekly chart. Let it be your best friend, and then you're going to find these big opportunities I'm going to show you. On that weekly chart, you want to have the 10-week simple moving average and the 30-week simple moving average. Here we have the weekly chart of Meta Platforms, which is previously called Facebook. So we can see that in 2022 bear market, Meta crashed about 70%. So if you had $1,000, you had about $3,000 left, which is very bad. But then after the market recovered from the market bottom, we can see that Meta went up about 720% to the peak. Now, of course, I don't think you could have bought at the bottom, but an ideal buying point was about here at around $178. And in that opportunity, if you invested $10,000, you could have ripped about $40,000 out of Meta. The next one is NVDA. So one thing that we like to look for is that after this bear market run in these strong industries, you see where the 10-week crosses the 30-week. So the 10-week is that fast moving average. So when it's trending up, it's one which is closer to the prices. And then the 30-week is one which is far away from the prices because it is a slower moving averages. It gets the average of the last 30 bars. So one good signal is this crossover. So you wait for the prices to go down, and once they come up, you want to wait for a reaction after the crossover. Or it could be very close to the crossover. So you see here, NVIDIA goes up, reacts. And then on that bar in early 2023, you could have bought there. If you invested $10,000 in NVIDIA during that time, you could have had $100,000. And I'm sure a lot of people have $10,000 sitting there. If you had $5,000 and you invested in NVIDIA, you had $50,000. And then in the next bear market, then you can be deploying maybe bunches of 10,000s into different companies. So maybe here from this NVDA, your 5,000 turns into 50,000. So after this bear market crash, then now you can find, you put 10,000 in 5 different companies, and if one of them is an NVIDIA, then that 10,000 would turn into 100,000. But this is where the big opportunities lie in these bear markets. Then the next one is Avgo. So this is broadband, and then we can see that after the 2022 bear market, also it recovered at very similar time to NVIDIA, and from the bottom to the top, it went up about 500%. So let's say you got lucky and you just put 5,000 in NVIDIA or 5,000 in Broadcom. This one could have gone up about 5 times. So your 5,000 turns into 25,000, and the NVIDIA would get your 5,000 and turn it into 50,000. So you would have 75,000 from 5,000, and this is just in about 3 years. The next lesson is stick to your guns. You have to understand which style of investing that you're in, and then you want to stick to it. Are you a value investor like Warren Buffett, or are you something like a long-term holder who is a position trader that uses technical analysis? And I'll show you. Let's say Alibaba. I remember very well Warren Buffett was buying Alibaba around here, $100, and he has been buying this whole time. He also bought here about $79. I remember the news. So you can see that over this whole time, for about 3 years, he's just been buying because he knows that the stock is intrinsically cheap. And then the other day, I saw it go from about $90, it has gone up 60%. So if he had $1 billion in, he has gotten about 60% in profit, and now it has crashed, but I think it's on the way to keep going up. So value investor doesn't even look at the stock price. They're just saying, is it under the intrinsic value? Now, personally, I'm not a value investor and I don't know a lot of details about that, but what I'm trying to say is that understand your style. Long-term holder is the strategy I was trying to show you here with Avgo and NVIDIA. So basically, once the bear market has ended, you find these strong companies, and then if you're a very long-term holder, you can use the 30-week moving average as your selling point. So here you'd have gotten in at around $15, and then you didn't have a need to sell until about $114. You can see the same thing with Meta. You got in about here, safe buy is about $150. You never had reason to sell until about $600. So this is how a very long-term position trader holds. He could also use a 10-week simple moving average, which is what I use. So I'm a little bit more active. So there are different types of long-term holders, but you have to know what strategy you're using. Are you a swing trader? Are you a day trader? Are you a dollar cost averager? So I feel like all of us do dollar cost averaging. When you go to work, every month you put some money away in your 401k, in your RRSP, then in that way you do some dollar cost averaging. So for me, I do two, dollar cost averaging, and I'm also a mix between long-term holder and a swing trader based on the opportunities. So those are my bread and butter. I'm not a day trader. I'm not a value investor. I'm not that patient. But you have to know which investment style you're on and stick to it, because if you try to keep switching around, then you're likely going to experience losses. You're going to be punished by the weaknesses of every investing style you try to go into. Because you have to remember, people mostly switch when it's not working well. That means you're switching during the weak times of that investment strategy. So let's say you're a value investor and the stock hasn't gone anywhere for 5 years. Now, if you switch into a day trader, then you're not going to be getting the 1,000% return when the stock eventually goes up, because a day trader is definitely not going to hold through all of those months. And then the next thing is, please don't fall for bear market rallies. So bear market rallies are some of the greatest wealth killers out there. And these are rallies that come within the bear markets, and then they trick you and tell you that, hey, invest your money, and it looks like the market is going up, but then it's actually crashing. But I'm going to show you how to avoid them. As I already told you, try to use a weekly chart, try to use the 10-week and the 30-week simple moving averages as your guides. One thing you should know is that 80% of stocks don't succeed in bear markets. I'll show you one good example. Here we have a stock chart of WGS. You can see this is a breakout. So here it looks like the stock price has broken out and it's going to all-time highs, which I think is a very good sign. Anyone would be very happy that this is happening. But see down here, when we look at the averages, they start to slope down. So even after this breakout, the stock eventually comes down and crashes. Same thing with every other stock. Root was looking good. It tried to go up during the bear market. it just crashed because the market is pulling it down despite the fact that it's a great stock. Another one which I was in, I know they tried to go up, but since the market was bad, you see it has a 70% crash. Despite the fact that it looked like it was going up, but then since the market is down and 80% of stocks follow the market, it just crashed. So a lot of people are going to be sucked in by these moves, but you have to keep waiting, keep watching the weekly chart. And until the market is free to go, just avoid investing. Avoid starting new positions. If you are impatient and you really want to start a position, make sure you're risking only about 0.3% of your account. And also the other reason why I want you to be patient is that many great stocks had their moves way after the bear market had ended. You can be very patient. I'll show you what I'm talking about. So here, I'm going to show you a stock called VST. So this is one of our biggest winners last year. If you want to be part of the newsletter, we're going to look at the weekly chart. So this is a 2022 bear market. You can see the NASDAQ and the S&P. So the bear market ended around this time. This was about 2023, early 2023. But you can see that this stock really was still going nowhere. Its breakout was here in about July, August of 2023. This is 8 months after the bear market had ended. And after that, the stock went up about 500%. So if you put in 10,000, it turned into $60,000. So you can always be patient. So another one here is Upfolio. So let's say the bear market ended around here. So you can see here, the bear market is ending. A good time to start buying is about here. So of course, you can see this moving average crossover. So you can buy here at $17. And then you could have held all the way for a 2,000% gain. But even if you came 8 months later, you could have still gotten a 900% gain. Actually, from here, it's about, 900%. 1,000%. Even if you came later, after there was this market correction over here, you could have bought and then gotten another 400% gain. So these opportunities will still come later. You can be patient. You don't have to be hungry to get in so early. So here we are studying the bear market rallies. So this is the 2022 bear market. One thing you should learn is that when the 10-week moving average crosses under the 30-week moving average, so we can see that crossover over here, then this market becomes untrustworthy. And the best thing you can do is normally wait for a higher low where the market tries to come down and fails to create a new low, or maybe just tests this low and then goes up. Or you can wait for this crossover where the 10-week crosses over the 30-week, and then you can buy once that crossover has been tested. That is a very good point to buy. But you can see these bear market rallies that last about 3 weeks. This one was 3 weeks, so people thought it has recovered. This one was about 7 weeks. People thought the market had recovered, but it just kept crashing and crashing. So we can see the bear market rallies. So here we have the crossover, the 10-week crosses under the 30-week, and then it first comes and then tries to pull in people. So here we see the market recovers about 15%, and people are like, great. But then you see it fails around the 30-week, and then it continues to crash another 20%. So if people bought here, then you get another 20% loss in your portfolio. That is if you don't sell quickly. Then the market recovers very quickly again. It does a 20% move up. Then it does another 20% move down. It was only until the market tried to form a new bottom, failed, then started to go up, forms this chit, this kind of consolidation here, and we can see the crossover. It tests that crossover, and then this is a good time to buy. You could have held for this very huge rally. And then after it formed this big consolidation, this was a very good time to add again. You could have gotten a very good stock over there. And then you're still going to get these opportunities. So now you can see that the market is also trying to recover, and it's going to do that same about that 20% recovery. And then I think it could still continue crashing. That was 2022. If we go to 2019, this one was a little bit tricky. The market crashed very fast. We see a very flash crash of about 30%. But then in about April, the market did recover. And by May, it was trying to go up to new highs. But of course, even if you sold here, you could have waited until you see now here the 30-week is sloping up. But since the 30-week moving average is sloping up, then once you see this chit here, this kind of consolidation here, then you could have re-entered again. And then you could have gotten a very huge profit. And that's what I try to show you here. I show you GE Aerospace, which is a stock. I show you the S&P 500, the NASDAQ, and then the GE. So we can see that The stock comes and then tests the moving averages at the same time that the market is bottoming, and then you can buy here. And then the thing went from $50 to $200, so very good return. Then we've already spoken about the 2020 bear market. Then I try to show you that if you waited, so Tesla was one of the leaders in the 2020 bear market. So it did crash, and then it did recover. So even if you didn't participate in this crash, so it comes back up here and then it forms this handle here, and then you could have bought at $50. The stock went up to maybe say an equivalent of $300. So you still made about 6 times your money back after that. Then the next one is the 2008 bear market. So you see this, once we have this crossover, we can always expect that the market is going to try to come and test it. So here we test it, and then the market looks like it's recovering because we have another crossover. It fails to form that testing of the moving average, and then bounces up. So what you want to see is a reaction. So it coming down and then going up again. So it coming down and then going up again. But it didn't do that here. It comes, it just goes down. Tries to recover, goes down again. So these are the bear market rallies that catch a lot of people. And only until the market failed to form a new bottom, then did it try to recover. So that is a good point to start watching the market very closely. Then we can see 2003, we can see there's a crossover. Like I told you, after the crossover, the market will try to come and test. After the crossover, it will try to come up again. A good sign is that whenever price looks like it's struggling to move in a certain direction, then it's most likely to go into the opposite direction soon. That is just one thing you can learn about price action. So it does that testing that we do expect, then it crashes nicely. It does a bear market rally for about 2 weeks. It continues to crash. Then it does another bear market rally for about 7 weeks, about 2 months. People are like, hey, it's recovering. Continues to crash. Does a bear market rally, crashes and again. And then finally, it does a nice crossover here. So you see here, there's a fake crossover here. But even if you took that loss, you got out early and the stocks would have stopped you out. That's okay. You've only tried once, and then you could try here again. And then you'd have gotten a nice return in 2003. So we can see for 3 years, the market just kept crashing. It didn't go anywhere. The next thing is cut your losses short. This is the most important lesson, because if you don't cut your losses, then you have to work very hard to get back to where you are. One thing I learned from my personal experience is that losses are easy to accept if taken early. So you should take your losses as early as possible. I realized that when I had very big losses, that is when I tried to hold on onto stocks. But the fact is that building your wealth comes from you compounding your wins. But if you're compounding losses, you're going to be losing money over time. And by small losses, what I mean is that if you're down $100, you're likely to sell quickly and accept that loss. But if you're down $5,000, then you enter into a state of panic and you start to hope that the market recovers. And then that psychological suffering makes people hold on. That is why I learned that it's always better to take your losses very early, especially in a bear market. The reason why you want to take losses early in a bear market is that there is an 80% chance that the market is going to continue falling. So you don't want to hold on to losses. Maybe if it's a bull market, that means that you have an 80% chance of it recovering. So maybe you might be bailed out in your mistakes, which is something which has happened to me. But during a bear market, holding on is likely to destroy you and your family, because I've seen people, they try to hold on and all of their wealth is destroyed because, first of all, they're leveraged and all of those things. So here I do have a chart that shows you, if you lose 5%, you need 5% to go back. If you lose 50%, you need to double your money to go back to where you're at. So cutting your losses short, it's a very short lesson, but I think it might be the most important. Then don't listen to the news. I like the phrase, trust the tape. And the reason you shouldn't listen to the news is that the news is in the business of clicks. So what they want is for more people to watch their news, to read their articles. The more views they have, the more advertisements they can sell, the more money they can make, the more credibility they have. So they're not really interested in making you money or losing your money. They're not interested in any of that. What they want are people to be glued to what they're saying. That's why they're likely to keep scaring you in good times, and then in bad times, they're going to try to scare you more or try to give you false hope so that at least you can go watch their articles and watch their little videos on YouTube. If you're watching news, at least in your head, just understand that this is pure entertainment, at least news in the stock market, because The other thing about stock market news is that none of those people actually has stock market experience. A lot of people there are not traders, even those financial experts. They're just experts on talking about the financial markets, but they're not experts on actually trading their own money. So don't listen to them. And one story that I really liked a lot while I was reading the book of Jesse Livermore is called Reminiscences of a Stock Market Operator. He's one of the best investors ever because he was very successful. Anyway, so one time this guy received a hot tip from influential insiders. So these are like tips that you hear, a secret from the president's office that this stock is about to soar. And of course, anybody that hears that, of course, is going to want to go buy this stock because they're like, oh, this stock is going up. The president has said and stuff. Anyway, Livermore, being a very smart guy, he knew that something was off. So he started digging into this story. And then he found out that those people who are sending out the tips were the major shareholders. And they wanted to unload their positions by hyping up the stock to people like him. So what does this mean? Holding billions of the stock is like let's say you have 1 million apples and you want to sell it in the grocery store. You can't just sell 1 million apples every day because every day a grocery store doesn't sell 1 million apples. So you have to come up with some special story about apples and about maybe how good it is for the health, or maybe apples are running out, they're going extinct. People will want to come and buy those apples. So that's what happens with stock as well. So whenever someone wants to dump billions of stock, they make up a very good story. For example, Tesla, they even go into the news and say, buy Tesla, this is a legendary opportunity. But if you look at the price is going down. Those people are dumping the stock. And what they're doing in those news articles is try to get people like you to buy into their hype, and then the stock is going to crash anyway. On the other hand, when somebody wants to buy a stock and they have billions, then they try to make some negative news that, oh, the market is going to crash, it's never going to recover, the USA is in this. And in that way, people like you get scared, dump their little shares, give them to these guys, and then they hold the shares, and then they wait for the government to print money, or maybe they know that the government is going to provide subsidies to a certain industry, or maybe they know that industry is going through some major innovation, and then they make the big gains. So the only thing you should believe in is in price and volume. This is another very important lesson. After cutting losses, this is the second most important. Of course, bonus, use bear markets as study time. So bear markets are good. Read some books. And of course, check out the resources page of the Profit Punch newsletter. If you're new, you'll see in the introduction to the stock market, you'll learn all about technical analysis. You'll learn all the buying strategies. You'll learn selling strategies. You'll learn how to make money in bear markets and also how to make money when the market recovers. So I hope you found value in this lesson. I try to share everything that I know, and I try to put a lot of time and effort into making these slides. I hope somebody can use this information. May the markets be with you.